welcome back to this week's market update. Today is Friday, September 8th, 2023, and we will jump right in. This week came at a bit of a slower pace of economic data as the bears outweighed the bulls this week across equity markets. As of close on Thursday, September 7th, the Nasdaq Composite ended down just over 2% here, while the S&P 500 ended down about 1.4%, and the Dow Jones Industrial Average ended down about 1% for the week. Right into our economic updates of the week, we had the ISM services along with the manufacturing indexes for the month of August that broke the trend of the last few months with a strong uptick in both indexes. The August services PMI rose to 54.5 here, pretty bullish sentiment in the services industry, with new orders and business activity leading this really strong data. According to the ISM services PMI, the services industry has grown 38 out of the last 39 months, with the only exception being the December of 2022 data that came in slightly below 50. So again, really strong services industry as shown by this index, and very different story in the manufacturing industry, which we will jump into next year. Like I was saying, in August, we saw the ISM manufacturing PMI also tick up. However, it was still at a contractionary level at 47.6% in August. This was the 10th consecutive month of contraction in the manufacturing industry, which is a very different story than the services side of the economy. Both the services and manufacturing PMIs shed a lot of light on inflationary pressures as well, with a still hot service sector driving inflation higher, while a cooling manufacturing sector drives disinflation and actually some deflation in the price of certain goods. Following the ISM services and manufacturing PMIs that we got this week, we also got initial claims data for the week ending September 2nd that showed some pretty important stuff. Just as the August unemployment rate increased to 3.8%, and economists were feeling a bit hopeful for a soft landing scenario in employment data, initial claims this week came in lower than expected at 216,000 for the week ending September 2nd. Labor markets are really continuing to stay strong amidst a Fed funds rate more than twice as high as it was a year ago. I think one observation from this unique macroeconomic environment we can say for sure is that it is quite dynamic and constantly shifting. Right now, we're seeing labor markets look fairly robust, still with the unemployment rate being below 4%, but again, that is subject to change at any point, just like we got a really low week of initial claims this week that surprised investors. So we will continue to monitor this really important employment data as it comes out. Also in the news this week, and partial cause of the market slump was due to Apple's stock decline relating to its government ban of the iPhone in China. The stock was down over 6% from open on Tuesday through close on Thursday amidst the headlines of Chinese restrictions on the iPhone. Currently, the ban only applies to government workers, which amounts to about 500,000 iPhone users. However, the concerns for Apple go further than simply losing 500,000 users. More sanctions from China could significantly eat into Apple's top line, with nearly 20% of their revenues stemming from the country. So here you can see another source of growth for Apple has really been China, where their revenues were about 70 billion in 2022. So China makes up a huge portion of Apple's supply chain as well as their sales, and so this is why the stock was so hurt this week from the news from the Chinese government. At this time, the only certainty seems to be the government ban on the iPhone, which is a very small portion of the total revenue that Apple gets in China. However, we will continue to monitor the situation closely as it could have a bigger impact in the future. Final update of the week is the September FOMC meeting is just about a week and a half away, and currently markets are pricing in a 95% probability of no rate hike, with the other 5% being a 25 basis point rate hike. Given the August 3.8% unemployment rate and a slew of other economic data showing the economy starting to slow down, investors are not expecting a rate hike at this meeting. However, this could change with the CPI prints coming in next week on September 13th. So we'll continue to watch this closely, and we'll also look ahead to the rest of the year here in this next slide. Looking ahead to the end of the year in terms of the Fed and more rate hikes, as of today, September 9th, markets are pricing in a 57% chance of no further rate hikes, with a only 40% chance of one small 25 basis point rate hike here. This is really interesting given that inflation remains well above 3% in most measures, and next year markets are pricing in less than a 1% chance that the Fed holds rates where they are through the end of 2024. I think next year rate cuts will either be a result of a really difficult economy and possibly a recession, or a really cool soft landing that the Fed is hoping for. In either case, we will continue to watch the data closely and watch the portfolios closely as well. Thank you for tuning in to this week's market update, and we look forward to providing another update next week.